Good morning, everyone. It is Monday, July the 13th, and welcome to 7 Investing Live. This is our live stream event where we focus on several of the market's most innovative opportunities. You can see all of our stock market recommendations that are official recommendations on our site at 7investing.com. And if you'd like, get free access to all of our premium content for your first 7 days at 7investing.com/subscribe. My name is Simon Erickson. I'm the founder of 7 Investing. I'm joined by our executive producer, Heather Horton. We're going to do a little bit of a different show here today. We're going to talk about the market in general and some of the dynamics that are at play here in 2026. This is an interesting way to kick this off, Heather, because we kind of have always had the idea that the market had a good year in 2025. The market seems to be having a pretty good year in 2026. But let's start this up by asking, what is the market itself? We typically talk about the market as publicly traded stocks, especially when our home court and our home turf here, the American market specifically. And so to kick this off, Heather, I have a question for you. I'm putting you off on the spot here because we didn't talk about this in production. But how many publicly traded stocks are there that are listed on the combination of the New York Stock Exchange and the NASDAQ exchange in the United States of America today? Are we talking 100,000 companies? Are we talking 50,000 companies, couple thousand companies?
I think we're thinking 10.
Okay.
Maybe. Yeah.
The actual number of publicly traded companies listed on the combination, again, of the New York Stock Exchange and the NASDAQ is 5,590 as of right now. So the market as a whole, if you wanted publicly traded companies on at least those two large exchanges, about 5,600 companies altogether. That, of course, doesn't include penny stocks, some over-the-counter exchange stuff, some of the things that are also tradable out there. These are just companies that are tradable on those two large exchanges, about 5,600 companies. But it's interesting that when we talk about the market, we're generally not talking about those 5,600 companies. We almost exclusively talk about the S&P 500 as the market benchmark we like to compare ourselves to. And so to start this show off, I'd like to take a look at what are the constituents in this S&P 500 today, and why is that dynamic as a benchmark kind of interesting, considering what's a part of it today. We got some really, really large tech companies that are dominating the S&P 500 index. So Heather, if you could drive, let's go ahead and put up some statistics about the S&P 500, what this really means. Here we go. There we go. There's the 5,600 total companies that are in all the major U.S. exchanges. We've got some stuff that's specific to the S&P 500, which again, this is a market cap weighted index of the 500 largest American companies, the most valuable companies that are listed on U.S. exchanges. Out of those 500 in the S&P 500, it's estimated that the total dollar value of the S&P is about 80% of the total stock market index. There we go. Perfect. Right there. Out of the S&P 500 constituents, there you go. 80% of the total value of all of the publicly traded listed companies are in these 500 largest companies. And again, the rest of the market outside of those top 500, only about 20% of the value overall. Look at this. The total market capitalization of the S&P 500 is $69 trillion. And we've got a year-to-date return of 11.4%. That's respectable. We're actually already in the first half of 2026 surpassing the average total return for the year annualized of the S&P 500 going back to the year 1950. The average total return on an annualized basis of the S&P 500 is 10.26%, 10.3% annually since the year 1950. And it's estimated that if you take actually the entire global market capitalization of all of the publicly traded companies in any exchange, in any market out there, the S&P 500 is about 50%, a little bit more than 50% actually, of the total equity value, the total market capitalization of all publicly traded companies listed globally. Holy cows. So a lot going on there, right? The S&P 500, really big index. We're looking at the biggest companies themselves. Let's see if we can get into the characteristics of the S&P 500. We've got a chart that says characteristics. Number of constituents is actually not 500. It's 503. Keep in mind, some individual companies have multiple listings within the S&P 500. One example, Alphabet, listed not only as the A shares, but also its C shares. GOOGL is one ticker. The other is GOOG. You've got one company with two tickers. That's why we've got 503 instead of just 500 for the S&P 500. The largest market cap, NVIDIA, at least at the time of this index's weighting, as it was right here, was $4.8 trillion. NVIDIA is the largest and most valuable company in the S&P 500 index. The smallest The 500th largest, if you will, company in the American stock, in the American equity markets is worth $5 billion, $5.1 billion. I didn't even do my research on what that is. It's not NVIDIA. But the median market cap, which means if you take half on one side and then half on the other, the one at the 250th position of the index in terms of size is still worth $44 billion. This is a very, very large index. The largest individual constituent, which is NVIDIA, 7.5% of the index. And then this is the last thing on this chart, is what I really want to call attention to, which is the weight of those top 10 constituents. The top 10 constituents of the S&P 500 now account for 36.4% of the overall S&P 500. Ladies and gentlemen, what that means is when you have a company like NVIDIA and Apple and Amazon and Alphabet that are moving, that moves the entire index. The top 10, except for Berkshire Hathaway, are exclusively tech companies. And when you've got the top 10 now accounting for more than a third of the index, the market is going to go with how big tech is going to go. That's been very good in recent years. AI has certainly propped up the computing power required by some of these high performance chips, the infrastructure required by these cloud titans, the software to support the AI models. This is kind of the biggest tech companies that we thought of as NASDAQ constituents in years past, but now this is the S&P 500's bread and butter, large tech companies, particularly playing in the AI trade. Now, I want to show another chart, though. That we all know the S&P 500. We know NVIDIA is a big company. We already talk about that all the time. Let's take a look at, if we were to look at all of the publicly traded American companies, right? We looked at those 5,600 that were publicly traded. What if we didn't just look at the biggest ones? What if we didn't exclude what's going on in the rest of the publicly traded market, not just talk about the NVIDIAs and the Googles and the Microsofts of the world? I'd like to direct our attention to the Russell 3000 index instead here. What the Russell 3000 index is doing. We've hopefully got a fact sheet on this. It's an FTSE index. There we go, right there. Perfect. Thank you, Heather. This is now not 2,996 holdings. These are the largest 3,000 companies that are publicly traded in the American exchanges. We already have the S&P 500. We talked about that. Let's expand that count by 6x. So instead of talking about the largest 500 companies, we're talking about the largest 3,000 companies. This is estimated to be a 98% of the investable dollars in the U.S. equity markets. Again, we said there's 5,600 companies to choose from. Some of those are very, very, very small. You're getting 98% of the total dollar value in the largest 3,000 companies. This is more interesting, in my opinion, because the median market cap of the Russell 3000 is only $2.7 billion. We're not talking about the mega caps. We're not talking about a median market cap of $40 billion. You're now starting to get into small cap land. $2.7 billion is the average size of the companies in the Russell 3000. And the performance of the Russell 3000 tracks very, very closely to that of the S&P 500, both up between 10 and 11%. If you consider dividends and total returns out there, you can kind of see the Russell 3000 in green there at 11.5%, the S&P 500 total return 11.4%. But I want to look at one more index too, which is the Russell 2000 index. And let's pull up the fact sheet on that one too. This is now, if we took the Russell 3000 and we took out the 1,000 largest companies in the Russell 3000, we are then left with the 2,000 smaller companies that are below those. And so the Russell 2000 index is really a measure of small cap performance in the U.S. equity markets. Again, we've removed the largest companies out there. The Russell 3000 included all the big companies. Now we've excluded the 1,000 largest companies in the U.S. market. And we said, okay, if we looked at the 2,000 companies that were smaller than those largest 1,000 out there, what are we getting in the small cap universe out there? Keeping in mind, the market itself is a lot more than just these big tech companies. So the Russell 2000 today, 1,975 total holdings, in that the median market cap of this index, only $1.1 billion. This is what you would consider small tech world right now. But this is really interesting. Heather, put that chart back up again, if you could. The one that you just put up, the performance returns. Perfect. The S&P 500 and the Russell 3000 have gotten us about a 10 to call it 11.5% total return in 2026 year to date. Respectable. But look at the performance of the iShares Russell 2000 index. The Russell 2000 index is now at 20.7% total return in terms of year-to-date 2026, almost double the total return of the S&P 500. In fact, this is quite the delta that we're not used to seeing very often. There's a statistic that came out last week that the Russell 2000, that's that blue chart at the top, just had its best first half of the year that it's had since the year 1991. So in 35 years, this is the best first half performance we've seen out of the Russell 2000. And in fact, it's beaten the S&P by the widest margin since 2001, after 5 straight years of underperforming the larger index. Excuse me, thank goodness, hopefully I muted that vicious sneeze as I took in that statistic, Heather. That's quite a margin and quite something to take a look at. Now, why is this? Why is it that small caps are almost double the return in 2026 of the largest tech companies? Well, let's ask a large tech company. Let's ask Google Gemini why it thinks the S&P is underperforming the Russell 2000 to such a degree. There's a couple of different reasons on why this might be. The first was the rotation away from mega cap companies. Everyone was getting so excited about AI and so excited about chip makers for a little while there. We can even put this up if we've got the graphic for us of what Gemini explained. But there's kind of been a rotation away from the mega caps. A lot of these chip makers kind of took a little bit of a breather. Whether we're talking about NVIDIA's or whether we're talking about the Broadcoms or whether we're talking about any of these other chip makers, I think in the last month or so, we've kind of taken a breather from these going, gangbusters through the moon, valuations getting very, very expensive. All these big announcements we saw with OpenAI and Anthropic and whoever else it was that needed infrastructure, needed custom chips. We saw a lot of momentum in that for the first part of the year and certainly in 2025. I think there's a little bit more of a normalization to valuation multiples for some of these big tech companies as the market digests just how expensive are these possibly getting. There seems to be some rotation away from the mega cap companies. In addition to that, small caps had really good earnings for 2026 thus far. In fact, the Russell 2000 has forecasted year-over-year earnings growth that has exceeded 40% in 2026. That's really, really good considering we're about 11% earnings growth for the S&P 500. Why is that? Well, again, Russell 2000 is a lot of tech companies as well, but this is where you get some of these smaller niche technology providers. And when you're a smaller company and maybe you've got some IP that's really cool, or you've got some kind of technology that's fitting right in there with the data center, like we talked about Lumentum in recent shows, things like this, these companies go gangbusters and they grow really, really quickly and they skew those averages. The average company probably is not reporting 40% earnings growth, but when you see some of those small companies that caught on and grew very, very quickly, you can see there is really some big fish to catch in the small pond of the of the Russell 2000. 2 and 3 are kind of the same thing. The theme booms, the under the radar AI plays, again, some of those cool companies doing really cool things. And then the valuation gaps too, just these massive multiple in terms of the cyclically adjusted PE ratio, the CAPE, if you will, just getting very expensive for those big tech companies. Maybe at some point, we're going to rotate some of that money back into the more widely ignored companies in the Russell 2000 out there. And then again, the last point that Google comes up with here is some funding from the government and other things as well. So thanks, Heather. Thanks for putting that up there. I think that this is interesting. There's one more thing I do want to put up before we kind of open this up and start talking about it, which is a graphic that shows the top 10 constituents in the S&P 500 today. We've got NVIDIA at the top. That's the largest company in the American markets. You've got Apple as the second largest company, and then Microsoft, and then Amazon, and then Alphabet, all the way down there to Berkshire Hathaway as number 10. These are the top 10 constituents that are accounting for 36% of the S&P 500 index. And there you see, if we're following the ETF that tracks the index, up 11.3%, the SPY, the S&P 500 total return. But you see, even though we always talk about how on fire AI has been, how amazing these tech companies are doing, what a tailwind this has all been, this is not amazing returns. This is kind of a tighter spread. You see there in the teens, from 10 to 15% for the year. The best performing of the top 10 constituents is Apple, up 16% year to date in 2026. And the worst performing constituent is Microsoft, the third largest constituent, down 20% year to date in 2026. There's various theories on why Microsoft has not performed as well as several of these other companies. Could it be that it was too late to design its own AI chips? Possibly. Could it be that Microsoft and Azure is losing share, or at least not keeping up with the share of what Google Cloud is doing, or at least what Amazon Web Services is doing? Possibly that too. Could it be a strategy change, or could it be that Microsoft has got too many legacy business lines that's holding its back? Possibly as well. The point of the matter is Microsoft is certainly out of place with the rest of these top 10 constituents, being that it has fallen 20%. Am I suggesting that NVIDIA is going to fall 20% in the second half of 2026? No, I am not. I'm not suggesting the same about Apple or Amazon or Alphabet or any of the other companies that has done quite well. But it does seem interesting that the market is at least considering that these companies are not perfect anymore. Microsoft being the perfect example of that, and showing, hey, maybe we're going to normalize those earnings multiples we're giving. Maybe we're going to scrutinize some of those earnings contributors to the bottom line, and maybe we're going to look at some of those growth drivers to the top line as well. There is certainly a case to be made that these stocks got very expensive, and the market is getting a little bit fatigued of the top 10 constituents that now account for 36% of the S&P 500 index. Heather, there's a lot going on there. I'm going to grab my caffeine source and ponder on that for a moment. But do you have any overall thoughts as we kind of look at how expensive the market has gotten in recent years? We always talk about how well NVIDIA has done. We always talk about how good big tech companies are doing. It does seem interesting that the Russell 2000 has underperformed the S&P 500 for 5 consecutive years. And now here in the first half of 2026, the Russell 2000 has got the widest margin of outperformance of the S&P 500 that we've seen since the year 1991. That might suggest that there's a little bit more appetite for small cap stocks out there right now.
Yeah, I think it's really interesting. It does seem to speak to fatigue of the big stocks that we've been talking about nonstop. And I think that there's also something to be said about people getting nervous about, when NVIDIA hit 1 trillion, people are like, well, can it double again? Like, can the largest company just, and then, now it's at 4 something, almost 5 trillion. So yes, they can keep growing, but there is a point at which these companies are so massive that their available market share just doesn't even seem to be very realistic. And these smaller companies, as you said, they're associated with these big companies. And so the larger these big companies' numbers gets, the more room these small companies have to support them. And I think that may be why. It's very interesting. I do like that people are looking into more stocks. We're not just hearing about the same 10 stocks over and over again right now. Something really interesting I hadn't realized until today was that the Russell 3000 just includes everything from S&P and NASDAQ of the largest 3000. That was really very useful as someone. So, and it is interesting that we use the S&P 500 as like the market, because as we saw, it is a big chunk of the market, but it's the S&P. There's so many more stocks in the NASDAQ. There are more stocks in the NASDAQ? That seems wild than there are in the NYSE.
Yeah, right. Mm-hmm. Tech heavy, right? We always called it the tech heavy NASDAQ, but now it's more or less the market index, or the market exchange, rather. It's kind of neat too, Heather. If we looked at the Russell 3000, which again, as you just pointed out, includes the 500 largest companies like the S&P does, but also all 3,000 largest companies, right? So large mega caps, large caps, mid caps, small caps, everything's in there in the Russell 3000. If we divided that up into the 2 sub-segments that the index has done, which is the Russell 1000, the largest 1000, and then the Russell 2000, the 2000 that are smaller than those 1000. One, just by definition, one third of it is in the 1000 index. 1000 and the 3000 are the largest companies. And yet that's 93% of the dollar value by market cap of the Russell 3000. The largest companies just are getting so large now. The market caps are getting bigger. It's forgetting the smaller ones where you've got 2,000 companies, 2,000 or 2/3 of the index is only 7%, right? You're almost forgetting about small cap stocks at this point. The questions I have, and really this kind of ties back to the 3 key points I want to make on this. When I say questions, let me come back to three key points, I guess I would say. The first is it's very, very difficult to compete against the big tech companies. We cannot assume that any one of us can go out there and design better software out of our garage than Google can do today, or host with better infrastructure than what Microsoft and Amazon have already got set up out there, or make a better GPU than NVIDIA has already done. Like the big tech companies, the reason you saw NVIDIA go from $1 trillion to now nearly $5 trillion is because they're really good and everyone wants to work with them. And I think that there's still more growth runway for the large tech companies to continue to outperform, just because it's getting very, 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 very difficult to displace them. Counteracting that, my second point is these companies have gotten very expensive. Just because of the indexes themselves and the way the dumb money operates, you flood more and more money into the market caps of these things. And fundamentals are very good. They're growing their business very quickly, but they're also getting very expensive in terms of price to sales, price to earnings, price to cash flow. And this isn't just software companies. These are hardware companies that are selling physical goods, chips, infrastructure, things like this, that you're now starting to see priced at, over 100 times earnings or over 100 times cash flow. That's getting pretty expensive for companies, no matter what cycle you're looking at, right? There's going to be some point in the future we're not paying 100 times cash flow for a hardware company. So I think we're going to start seeing some contraction of the multiples, even with strong fundamentals as these companies continue to grow. And then the third point, which is what we're going to talk about on either Wednesday or Friday's show coming up later this week, is are there opportunities that are being ignored in the small cap fish pond? Can we go fishing in the Russell 2000, where the average market cap is only $1 billion, and pluck out and find the companies that are going to benefit from AI or quantum computing or any of these really cool technologies that the big companies are harnessing that have got some neat IP, some neat technology that's going to fold right into them, and they're going to benefit a massive amount from? If we can find those fish there, that's where the 20 baggers are hiding. Maybe even the 50 baggers are hiding. A company that's got a $1 billion market cap today that catches on very, very quickly into these massive trends can very easily be a 20 or a $50 billion company tomorrow. That's where we're going to go hunting later in this week, Heather. We're going to pull up 3 ideas in the small cap fish pond that I think have got 20 bagger potential. Very high risk, very high reward, but I'm kind of excited about that show coming up here as well.
I'm really excited about that.
It's going to be a good one. We're going to talk about that one a little bit. I'll give you a heads up in advance so we can discuss it. But that's going to be the next show. I think that today's, we're coming up on the midpoint of the hour. I just wanted to define what the market is, why the S&P 500 maybe isn't the perfect gauge always when you're comparing against the broader market. And then what are we forgetting about in those 5,600 publicly traded companies on American exchanges? Just kind of a neat way to look at the benchmarks. I hope that everyone considers that when you're comparing either your own performance returns or an index fund's performance returns, or maybe a professional fund manager's performance returns. What are they looking at? Is that the right benchmark? And then what is the biases in those benchmarks here in 2026? So, hey, we're looking forward to going fishing. We're going to look at the three small cap ideas later in this week, and hopefully have a very fruitful and interesting discussion about what these companies could be in the future. Looking forward to joining you on that show coming up later this week. In the meantime, today's Monday, the 13th of July. Hope you have a great rest of your day.